Chapter 10, Stockholders' Equity. Now that we have learned about more transactions that affect stockholders' equity, we need to review how to prepare and analyze the stockholders' equity section of the balance sheet, as well as the statement of stockholders' equity. If you take a look at this example for this corporation, you'll see the stockholders' equity section of the balance sheet. Preferred stock is usually listed before common stock in the balance sheet, given its preference over common stock. Next, you list common stock. The dollar amounts shown for common and preferred stock are based on the number of shares issued times their par value. You notice here that they have common stock, the par value listed, the number of shares that are issued. If you multiply these out, it's 1. These are in millions, so they round it up. Then you have the additional paid in capital account. That is anything that people paid over par value when they purchased the shares. The total of the preferred and common stock and additional paid in capital gives you the total paid in capital portion of the balance sheet. Next, you need to list retained earnings. Remember, retained earnings, we discussed how to calculate that, and it's a cumulative amount over each year since the start of the company. After retained earnings, you need to subtract treasury stock. Make sure you're showing treasury stock as a subtraction, as a negative number at the cost that you paid to repurchase the treasury shares. The total stockholders' equity is your total paid in capital, your retained earnings, and your treasury stock. So this is Canadian Falcon. You see they had preferred stock. We discussed at $30 par value, 100,000 shares authorized, 1,000 shares issued and outstanding. Remember, go back and review the difference in authorized, issued, and outstanding. The 1,000 shares times the $30 gives you the $30,000 balance. Common stock, penny par value, 1 million shares authorized, 2,000 issued and outstanding. The 2,000 times the penny gives you the $20. Additional paid in capital is those amounts that were put into the company over par value, gives you total paid in capital. The retained earning balance for the years for the company since its inception is shown, and in this example there is no treasury stock listed, so the total stockholders' equity section of the balance sheet is $100,000. You guys remember the statement of stockholders' equity? I know it's been a while since we looked at one. It's changed a little bit since the last time we saw it. There's more columns here. It's because we have more accounts that make up the stockholders' equity section of the balance sheet. Remember your 3-line header: Canadian Falcon, name of the company, statement of stockholders' equity, and then it's for the year ended December 31st. So when we looked at this in previous chapters, we had the common stock account and we had the retained earnings account for total stockholders' equity. Now we've expanded that to have preferred stock, additional paid in capital, and treasury stock. Make sure when you're recording these things, you're putting them in the proper column. So in this example, the beginning balance on January 1st is 0 in all these accounts because it is the first year of operations. Then we list all the transactions that have occurred that affect stockholders' equity throughout the year. We issued common stock, so common stock column has $10 in it, which is the par value, and $29,990 is the additional paid in capital. 10 plus $29,990, carry it over to $30,000. We issued preferred stock. Preferred stock column has the par value, then the additional paid in capital. 30 plus 10 equals our $40,000. We purchased treasury stock. Remember that from a few videos ago? We will record treasury stock as a negative $3,000 when we purchased it. It's decreasing our stockholders' equity. So we will pull that over to a negative 3. Then we resold our treasury stock for more than we paid for it. So we take the treasury stock out at the $3,000 we paid and record an additional $500 to additional paid in capital. We received a total of $3,500. We paid cash dividends of $500, so those go under the retained earnings column because they decrease retained earnings. Make sure you carry it over. We declared a 100% stock dividend, so we increased our common stock account by 10 and decreased retained earnings by 10. That net effect is 0. Lastly, the company had a net income of the year of $30,000. The $30,000 goes on the retained earnings column, pulling it over. Once you have recorded all these transactions, add down and add across. Your balance at December 31st in preferred stock is $30,000. Common stock is $20. Additional paid in capital is $40,490. Retained earnings $29,490. Treasury stock is 0 because we resold all of our treasury stock. Our total stockholders' equity, when you add down and across, should equal $100,000. Do those numbers look familiar to you? They should. Remember, when you're preparing your financial statements, you have to prepare them in a certain order. We prepare the income statement first because we need the net income for this line item right here. Next, we prepare the statement of stockholders' equity. Then we prepare the balance sheet. We take the ending balance in each of these accounts and list them on the balance sheet. You cannot prepare the balance sheet until you prepare the statement of stockholders' equity. All of these numbers come from right here at the bottom of the statement of stockholders' equity.